Equity markets globally continued their late 2023 rally into the first quarter of 2024. In January, rate cut expectations had reached what we believed to be highly optimistic and unrealistic levels. Many were factoring in a first rate cut as early as March, and as many as 6 to 7.25% cuts during 2024. This expectation helped spur on the advance in equity markets, but as the quarter played out, those expectations pushed out the likely date of the first rate cut and drastically decreased the magnitude of cuts. The market is now factoring in only 1 to 2 rate cuts this year, less than the Fed's own dot plots. What was remarkable, though, is that equities continued to rally into the end of the first quarter, even though the reason for that rally had dissipated. The primary argument for this continuing rise was positive earnings. Stocks were rallying because the earnings trend and earnings revisions were positive. However, what isn't talked about is the size of the stock price movements versus the size of those earnings revisions. Over the 12-month period to the end of Q1, S&P 500 earnings revisions were up roughly 10% versus market price increases of roughly 30%, 3 times as much. Some of the more extreme examples over that 12-month period at a mega-cap level include Microsoft, Alphabet, which is Google's parent company, Amazon, and Meta, Facebook's parent company, as we can see in this chart. This shows that whilst there has indeed been earnings growth, price movements have far outstripped increased earnings, meaning that the majority of the gains came from multiple expansion, and by extension, bullish assumptions being made regarding the earnings growth numbers many years into the future. This ignores any competitive destruction that comes from increased competition entering a highly profitable market segment, which we know is the natural result of a capitalist system normally. Yes, the size of the opportunity may expand, but margins are near historical highs in AI-related businesses, and these margins will come under pressure eventually, we know that, and there is still extreme uncertainty around what AI will look like 5 to 10 years' time from now, and who the true winners will actually be. Yet none of this uncertainty appears to be factored into current prices, given the multiples being paid. During this first quarter of 2024, we tweaked our global equity exposure to pursue relative value by including an allocation to quality global small caps, as these look relatively cheaply priced compared to their large cap quality peer set, but with the same attractive characteristics. We maintained our positioning that more pro-cyclical regions, sectors, and factors styles should be the new leaders of the market if the US economy remains robust and we see a true reflation trade occur. And in fact, this is how the market actually began playing out in March and into April this year. My colleague Shane Wang will elaborate on the outlook from here.